There are two prevailing opinions about real estate as an investment for everyday people. One, your home is your biggest and best investment. Two, real estate isn't a good investment. You should put your money in the stock market because it performs better. We're going to look at both of these opinions today, and to do so, we're going to visit Granny's house. My name's Bruce Brown. I'm a real estate broker in Ottawa. I work with clients here in the city and throughout Eastern Ontario. You can find real estate data, analysis, and strategies for buying or selling properties for home or investment on my website, ottawaagent.ca. You can always connect with me directly through my site or by clicking one of the links in the description below. Let's go to Granny's house. Real estate events in our lives are often linked to major life milestones, as I'm sure you know. You start a family, you need a bigger home. You're just graduated from college, you need to rent a condo. Your kids all move out, you want to downsize. One of the events that hits many of us in our lifetime is Granny moving on from her house. Often the house that she owns outright and has lived in for decades. So let's say this happened to Bob. Bob's granny moved on from her house. And Bob had to take over looking after the house and figuring out whether to sell it, keep it, or whatever else. So Bob hired an appraiser to come in and evaluate the house, and he discovered that here in 2024, Granny's house is worth $544,000. Bob starts talking to family about Granny's house, and he's reminded by Uncle Joe that Granny paid $34,000 for that house in 1962. $34,000, and it's worth $544,000 now. That is pretty impressive. Bob is thinking, wow, a person should just buy a house. I mean, look how much it goes up in value. That's crazy. Did Granny realize she was sitting on $500,000? Let's take a look at the numbers underlying that appreciation of Granny's house here in Ottawa. This is a graph of the average house price history in Ottawa. You can see that back in 1956, houses were worth, well, according to this graph, pretty close to nothing. It was probably in the 20,000s, maybe even under 20,000. The scale doesn't make it easy to figure out exactly how high that is, but it looks like it's around 20,000. 1962, looks like the average house was not worth much more than it was in 1956, but that graph just slowly climbs and has this little exponential aspect to it until, of course, just after the pandemic there, when we see the first pretty significant little dip. Putting some specific numbers on that curve, this table is extracted from the data that's behind that curve, and it shows the average appreciation in each of the decades since 1956 to the present. You can see that the overall annual average appreciation of homes in Ottawa, that first line, 1956 to 2023, shows 6.1%. So houses, homes in Ottawa, this includes freehold and condominium homes, have gone up on average 6.1% per year since 1956. Each decade had a slightly different characteristic. The 90s, those of us old enough may remember that things were relatively depressed. The average annual appreciation in that decade was only 0.9%. People think that the 2010s, maybe the 2020s, we've had extreme appreciation and acceleration of house prices. But in fact, when you look at the numbers, you see that the 70s and 80s, the average appreciation was much higher than in the 2000s and 2010s. In any case, the point of these numbers is simply to show a little bit more of a breakdown with specific percentages of how Granny's house got from the $34,000 to the $544,000, and we'll look at that in a little bit more detail in a minute. The appreciation that Granny's house went through supports people with opinion number one. Your home is your biggest and best investment. Look at the appreciation, 6.1% over all those years, compounding, yielded Granny a pretty good outcome. What would have happened if Granny had put that $34,000 in the stock market? This graph shows how the TSX has performed compared to real estate in major centers in Canada since 1996. I didn't have access to a graph that went back to 1956. But this shows you that the stock market has indeed, on an annual return basis, performed better than real estate appreciation in all of the major cities in Canada. Ottawa would not be an exception. We know that in Ottawa it's been 6.1% since 1956, 8% for the stock market. So, people with opinion number two, your home is not a great investment or real estate's not a great investment, you're better off just putting your money in the stock market. There's some weight here for them. 8% seems to be better than 6.1%, and compounded over 50 years, 60 years, that can make a big difference in the final outcome, and we'll look at those details. But let's take a look at this from a practical standpoint and break down exactly how you would invest in each of these vehicles and see what happens. To do this, I decided to use Canadian national figures rather than Ottawa specific figures. So in that TSX graph, it states that the national average house price appreciation since 1996 has been 5.7%. And although the TSX figures on there show 8%, to simplify things and to be conservative on both sides of the equation, I decided to go with 7.9% for the TSX, 5.7% for the real estate. So let's compare in more detail the TSX performance to Granny's house performance. There are a couple of things we have to remember here. So if the TSX has delivered 7.9% and Granny's house delivered 5.7%, that's a difference of 2.2% by which the stock market beat Granny's house. But it's not even quite that straightforward because Granny didn't have $34,000 in 1962. Granny had a mortgage. She had to pay mortgage payments. She had to pay interest. Granny also had to pay property taxes, which are typically about 1% of the value of the home per year, and she would have paid those property taxes every year since 1962. Granny also had to maintain that house. If she didn't maintain it, it wouldn't be worth $544,000 today. It might be a tear down. Hey, I'm the real estate agent guy here, and so far I'm painting a pretty negative picture of the real estate side, aren't I? So with that in mind, if we do a little subtotal on where we are right now, the TSX would deliver 7.9%, Granny's house would deliver 5.7%, minus 1% for property tax, minus 1% for maintenance. We won't worry about the mortgage for the moment. Granny is now at 3.7% net gain, and that means that the TSX would have been 4.2% better per year. However, as we said, Granny did not have $34,000 to buy her house cash in 1962. Granny had a mortgage. So therefore, Granny also would not have had $34,000 cash to invest in the TSX. How would Granny have invested her money in the TSX? With the house, she'd take on a mortgage. The TSX, she would put some money every month, savings, into buying some stocks. Well, how much would Granny have to do that? I found this really cool study from 1967 online. Have a little look at it here. Here we go. Check this out. Some nice faded yellow paper, 1967, preliminary estimates, income distribution and poverty in Canada. I scrolled through this document, which is pretty, it's got all kinds of tables, charts, really interesting data in it. And the pertinent thing that I found was that in 1965, the average income in Canada was $3,633 per year, not per month, not per week certainly, per year. There is an age-old principle, and actually this principle was reiterated, I believe, in The Wealthy Barber, which I read decades ago, of saving 10% of your income. With the power of compound interest, if you could take 10% of your income and put it away every time you get a paycheck, pretend it doesn't exist, you will get used to the fact that you don't have that money. Put it somewhere where it's going to compound, and in 50 years, you're going to have a lot of money. Based on that principle, let's say Granny took 10% of her gross income and invested it or saved it every month. She's going to be able to save $30 a month from her $3,633 income. $30 a month at 7.9% per year appreciation from the TSX would have Granny worth about $209,279 in 2024. Granny's mortgage on the $34,000 house with 20% down and 5% interest would have been $158.20 a month. in 1962. So if Granny's going to invest 10% of her income, $30 a month, let's say she saves that $30 a month from the cost of her housing. So rather than spending $158 a month on a mortgage, she's willing to rent a place for $128 a month to ensure that money she would have been putting into the house is going into the TSX and not into a house anyway that she's not going to own, which would be throwing it away. She has to live somewhere. But we have to remember too that in addition to that mortgage, Granny would have been paying the other 2% for property tax and maintenance. So what if Granny takes that money and invests it as well? Well, that's another $340 for property tax and $340 for maintenance per year, 1% of the value of the $34,000 house in each case. So that gives Granny another $680 a year to put into the TSX. $680 a year. Doesn't really sound like much, does it? But look what happens. $680 a year is about $57 a month. Granny was going to put $30 a month into the TSX. Now she can put $87 a month into the TSX. This makes a huge difference. Instead of ending up with $210,000 in 2024, now Granny is going to end up with $607,000 approximately. That sounds like it's bigger than the $544 that her house would have been worth. There are a whole bunch of factors we are not taking into consideration in this very simple analysis. And everyone's situation is different, and the complexities of personal finance and the economy are obviously huge, and it's very next to impossible to factor in everything. And I'm certainly not going to try and do that with numbers. I will bore myself to death, as well as making you never want to come back to this channel again. And by the way, you might want to come back to this channel again if I can possibly say things that are interesting. If you think that I do, if you're learning something about real estate, then please, by all means, subscribe. Would love to have you as part of the group here, analyzing what goes on in real estate and understanding how it works. When you look at both scenarios, the results are not that different. They're relatively the same order of magnitude. $609,000 from the TSX, $544,000 in the value of Granny's house. But in either scenario, are you really investing? Are you purely investing? Not really. What you're doing in both cases is you are saving, which is good. You should save. That old 10% principle or more or less. You're putting some of your money away and allowing it to compound. In either case, you're doing some prudent saving. On the buying a house side, you've got a little bit more control over your lifestyle and your destiny. Maybe you will get more enjoyment out of your home when you own it than you would renting. On the TSX side, you're more mobile. You're not tied down to a physical asset or place to live. You can move around. Both are better options than spending all of your money on Uber Eats if you want to end up with some money in the bank and maybe not having to work for a living one day. But in either case, are you really investing? Not really. You're saving, which is good. You are using dollar cost averaging, putting some of your income aside every month, or you're paying down the mortgage on your home and putting your money into a piece of real estate. Either way, you're saving over time and getting the benefit of compounding, but you're not really investing because you are the one saving out of your own income and paying all the associated costs, whether it's brokerage fees, transaction fees, interest on your mortgage, maintenance on a property. Either way, you're paying all the costs and saving out of your own income a small amount of money every month and absolutely ending up growing some wealth in the long term. With the cash savings, stock option, crypto, whatever vehicle you choose, methodology, that's your limit. It's every hard-earned dollar you can afford to put into it is going to grow, but that's your limit. With real estate, it doesn't have to be that way. In the next video, we will visit Granny's house again for part 2, and we will look at how real estate really does change the game.